Happy Halloween and good morning to everybody. It's Thursday, October 31st, and this is the AgYield War Room. I'm Dan Dempsey, and I'll be moderating today's session. As always, if you've got any questions or comments, please feel free to drop us a line in the chat area, and we'll be sure to get to it during the show. Overnight markets here, December corn unchanged at 411.5. November soybeans were up 6 3/4 at 983 1/4. And December Chicago wheat was down 5.5 at 567 3/4. This morning we had weekly export sales out. Corn came back about 2.3 million. That was in line with estimates. Soybeans were a little over 2.2 million as well, which was at the upper end of the range. The top end of the range was looking for 2.8 million. Wheat sales 411,400, which was right in line, and meal sales at the bottom end of the estimates at 208,400. The USDA also had a daily announcement for export sales this morning, 150,000 metric tons of meal to unknown for 24. We are through 22 of 23 settlements for the harvest price discovery. So today we'll wrap that up. Corn is currently sitting at 416 and soybeans are at 1004. Good morning, guys. Dustin, maybe a few thoughts to kick us off this morning. I know we were talking before the show, 97 deliveries in the bean complex overnight. So maybe a few thoughts there, and then we'll throw it around the room.
Yeah. So, even with these deliveries, we still had some spread narrowing Nov to Jan initially overnight. So it's not like we saw a huge jump in registrations. We are, it's just also a reminder too of these contracts are geared to go downriver. So you look at like corn, for example, Dece March is widening out a little bit overnight. And I think we have to look back to the last few contracts. Like the September contract was first, when we got into first notice day, we traded near full carry. Then we actually traded at a 100% full carry during that delivery window, except the Dece. So even though we've had a really strong basis for beans, rail basis in St. Louis was a record for this time of year, or not. It was at least the highest in the last couple of decades. We still are getting deliveries. So it's a reminder that these are not rail contracts; these are river contracts, and these deliveries kind of exemplify that, I think.
We got a little bit of water rolling through the Midwest too, which I think is welcome reprieve. They're not showing much improvement though in the Mississippi. So, still appears to be kind of an interesting situation down there. Dustin, maybe a couple things to add there.
Yeah, they need quite a bit of rain to catch up. And, I'm not ultra familiar with the NOAA, the water forecast tool that they have. Like it might be that they measure it after the rain falls. They don't take the forecast into account, but like the latest still has us at 9.4 minus 9.4 in Memphis. It's not quite last year's record, closer to minus 13 as we got into end of November there, especially. That I think that was a big part of why everyone attributed such a wide spreads last year. Despite having a really tight carry in and having yields below trend, we still got spreads ultra wide. We just had enough corn acres at the time. This year, I think that we have an extra 400 million bushels coming into this time frame, and we're hearing record yields, less acres, of course, and very, very strong demand. So that's why there's kind of a huge debate here of should the market be this tight on spreads, or this low on flat price, or is one of those two a mismatch? Maybe flat price is too low and spreads are telling a better story, or maybe flat price is adequate and spreads could widen. It could stay the same, no question. But I think last year is still a testament in my mind of what can happen once you finally start moving some of these paper contracts. So if there's anything that's a DP or basis only contract, that still needs to come up for a decision time here end of November. And if river levels are staying as low as they are, I think there's definitely, in my mind, there could be more risk in the December contract than there is in the March contract. So if you have December basis only December delivery, that's just something to kind of consider. again, anything goes. It could narrow if there's a ton of demand that just needs to move before the end of the year too. So I don't want to just set it in stone that. But I think we're getting some pretty good cues of what happened even after a monumental squeeze in the Nov-Jan bean spreads, and we're getting bean deliveries all of a sudden. And then what happened in the September contract. So very encouraging to see corn spreads start to widen back out here the last couple of days, and just market normalizing. I think the strength in my mind still needs to be at the back end of the market, where we're going to be very tight globally, close to that 10% stocks to use ratio when you take out Chinese stocks. And so, what kind of weather premium does the market need to attribute to Brazilian second season corn crop? What type of premium do we need to put back into the U.S. crop just to make sure we get enough corn acres next year? We have seen that ratio starting to fall, as we talked about yesterday with Jason. That Nov bean D's corn ratio for 25. But really to get all those corn on corn acres back, I think we need to see either higher prices or a much lower ratio than the average.
Yeah, I'm just going to add to that real quick. So two different things. First, on the spreads, I think a lot of times hedgers or speculators bull spread or, try to buy that spread to hedge basis risk, which is a problem when you realize that you can't actually take it and get it to the places that the basis is on fire easily. So I think a lot of times you see bull spreading or speculative buying to hedge, so to speak, hedge that basis risk. And then I think it implodes on them when they realize that they're not going to actually take delivery of these receipts, load them off a barge, take them to the spot where the basis is on fire. And then ultimately they have to get out of those paper contracts. So I think there's a false sense of security in bull spreading to hedge basis risk. And that doesn't work in a lot of different scenarios. So it works if you're a commercial and you're doing it because of, like you said, export demand or, things that are based along the delivery system. But it doesn't work for, a speculator in the middle of Iowa that's doing it to hedge basis risk. So I think a lot of that happens every year and then it backfires. But that's my first point. My second point, and Ben and I talked about this yesterday, and I think the ratio does make sense when you talk about, if you're below 2-to-1, obviously that means beans divided by corn incentivizes a bunch of corn acres. The other factor of that, though, besides just ratio, is flat price and profitability. So when you have a low ratio in profitable years, you switch corn acres more easily, to corn acres more easily, because you're profitable, and B, you have the money to spend. We've seen in negative environments, when both crops, you can't pencil a profit, that ratio can go lower than you expect because of the cost differential between growing corn and beans. And you touched on this yesterday, Dustin, but I think it's important to look at both the ratio and general profitability and flat price. Because you even when you're profitable, you can gain more corn acres in a higher ratio just because of the gross dollars. So a lot of farmers will bet on, hey, I'm making money in both corn and beans, flat price is really high. I have more confidence in growing, 250 bushel corn than I do, 80 bushel beans, for example. So there's a lot of different factors. Ratio is a key one that we look at, but you also have to look at, all the other things I just talked about.
Yeah, I can't wait. We're trying to line up some folks to talk about some of these new soybean genetics, and it'll be interesting to see what, how that shapes that discussion too as we go forward,
Oh yeah, and optimism too. So every year it feels like there's a theme. You're kind of going into spring and like, what looks more exciting? It's like, is it biodiesel, crush facilities, you get excited about beans, or like there's a new demand, source. Like for instance, around our farm, by next fall, they're putting in a new, rail facility, to go down in the panhandle. Like we're estimating, 20, 30 at least cent basis bump just from that new demand source. So it is regional too on what looks more exciting for next year. Is it, hey, we're selling a lot of corn right now. Exports are really good. There's definitely a lot of speculative nature too, by most farmers on what looks exciting for next year. So it's not an easy,
No.
it's not a 1 + 1 = 2 thing necessarily.
Well, and you
Yeah,
saw Fields coming out for 300 bushel. I mean, there's going to be a chase for that now.
Yeah, right. There's just a lot of factors.
Yeah,
Yeah.
I would add to it too, though. Like some of the people that have fallen into the corn bean rotation that had maybe been more corn on corn traditionally, and that might have started, back in that 2016 to 18 timeframe. They're not switching back unless it's really, really incentive to corn on corn. Because
and I think it's probably less acres too, right? Like the amount of acres that you're willing to switch is down from what it was 10 years ago.
Oh yeah, which surprises me. I think just the agronomic benefits obviously are just so great, and logistical benefits, but the falling into that, we're not going back more than likely to really heavy corn on corn, in my opinion, in those areas.
Yeah, I think the ice states for sure, and we went from growing 60 bushel beans to 80 bushel or 90 bushel, so it became just, instead of a rotational crop, it's an actual crop. And it's a diversification tool. It cuts down on, disease pressure, all those things. So I agree. I think, where you used to maybe be willing to switch, call it 20 or 30% of your acres, now it's much, much less.
Yeah.
Ben, couple thoughts to wrap us up here this morning.
Yeah, just taking that to kind of where my head is at in the markets. I definitely think that the back end of corn is cheap. The ability for maybe some things to switch in the bean market, I think, would be the most supportive things to make corn work a little bit more, as opposed to maybe the market just sending a message that, that we don't need a lot of anything. And the big January report, there's some rumblings that we could see a reduction in bean yield because of the poor finishing weather. I think that starts to, if we could see that materialize, even if they dropped it a bushel and a half or 2 bushels, we would still have a massive bean crop. And I think it makes beans a little bit more interesting. And then if we saw yesterday some early weather models starting to maybe flop back a little bit for South America, I think that really becomes where you don't have a lesser of two evils to look forward to for next year, but maybe some competitiveness into the spring to give us a decent bump to where everyone all of a sudden goes, hey, maybe this is, maybe we need a little bit more than we thought we did 3-4 months ago. So, and right now that onus is on beans, and eventually we'll move into safrinha, but I think that would make things a little bit more exciting in our markets.
Very good. Ryland, we get a couple minutes here before the open. Cattle, second tough day in a row, but interestingly enough, 9 of the last 10 hog sessions for February have been a new high. So still trucking there.
Still trucking. I mean, there's no doubt. I mean, it seems like it's a real cash-led rally, and you got the shorts on the ropes here, and we're seeing bigger and bigger increases in open interest. So, I mean, I think you got a good mix of, some real new buying, and probably a lot of producer hedging at this point. But, the cash news is good. It feels like it's somewhere between a really tight supply right now and just pretty firm demand. Overall, just kind of seemed like, weekly net sales were up pretty sharply from the previous week at 44,800 metric tons. So, I mean, like, the demand story is still here. It just feels like futures are kind of in no man's land. We've seen this many times before, and it just feels like shorts are on the ropes. And there's no telling where it's actually going to stop. Cash is moving kind of in a contra-seasonal kind of way. So I think the move did catch a lot of people off guard. So we'll see where it finally stops, but there's a lot of great opportunity just to get a much better floor in here. Overall, we've been saying it for a while now, just in case this is something more near term. Kind of feels like could be maybe a little bit of an end of month kind of thing, but overall really good news. I mean, this feels like the hog market's waking up to a large degree, but we'll see how much momentum it's going to get from here. But on the cattle side, a little bit lower kind of cash in the north yesterday, 296 to 298, just with the board dropping here. It looked like you got a little bit of antsiness, just guys hitting packer bids. So 190 in the south, that was pretty steady. So overall, it just just seems like probably seeing some hedging, a little bit of new selling here, out in the back end of the market. But I think there's a lot of concern just with the pricing structure and what happens over the next 6 months. So I think we're getting a little bit of that. The export market didn't really do much as far as, paint a good demand picture this week. So we'll see what comes about now that we're actually trading cash.
Very good. Thanks for the update. Just came into the open here. We got December corn up a quarter at 4.11 3/4. November soybeans are up 7 at 9.83 1/2. And December Chicago wheat is down 7 cents here at 5.66 1/4. A couple things to note. Tomorrow morning we will have Fun Fact Friday. It'll be Friday, so Brian will be all fired up and ready to go. Always a good way to start your weekend. We appreciate everybody that tunes in on a daily basis. If you wouldn't mind, throw us a like or subscribe. Certainly helps us. And again, we appreciate everybody that supports the show and tunes in on a daily basis. Thank you very much. Every day that the markets are open, we're streaming live on X, Facebook Live, and YouTube Live at 8:15 Central Time. Hope everybody has a great day. Happy Halloween again. And we look forward to talking to you again tomorrow.
Thanks, Dan.
The War Room is proudly presented by AgYield. For over 50 years, the AgYield team has provided grain marketing and risk management solutions for growers across the country. Our veteran consultants harness cutting-edge technologies to pinpoint risk, optimize market performance, and protect your farm's profitability. Discover a new approach to farm revenue management at agyield.com.
Hey guys, Jack here. Be sure to support the show by hitting the like button, leaving us a comment, and subscribing to the channel for all the latest updates. Thanks for watching. We'll see you next time.